Ladies and gentlemen, good day and welcome to the Thermax Limited Q1 FY23 earnings conference call, hosted by DAM Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital. Thank you, and over to you, ma'am.
Thanks, Faizan. Warm good morning to everyone. On behalf of DAM Capital, I would like to welcome you to the Q1 FY23 earnings call of Thermax Limited. We have the management today being represented by Mr. Ashish Bhandari, Managing Director and CEO, and Mr. Rajendran Arunachalam, Group CFO and Executive Vice President. I'll now hand over the floor to Mr. Bhandari for his opening remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Thank you very much, and a warm welcome to everyone that's on the call. I'll keep my opening remarks very brief. You can see the numbers as we have reported them. No surprises. We expected going in a very difficult quarter in terms of margins, and that's what shows up in our numbers. Particularly April and May were very, very difficult, and June overall had much better performance. That gives us confidence for the rest of Q2, what is coming, and the visibility that we have into portions of Q3. I think there's just too much going on in the macroeconomic environment to predict too far out. But overall, happy with the orders intake that we have. Happy with the broad-based number strength, and this is not just one large order. Everything, the strength below that, and some of the very specific information on international chemical services, some of the investments, etc., that we have made, the partnerships that we have started. Happy to answer those questions as you ask them. So with that, let's just get into the questions themselves here.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The first question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Good morning. So my first question is on the margins. I remember in the last 2-3 quarters when we asked you that the value growth is how much in your new orders. You said that value growth is pretty much covered up by the client, and we assume that you partly, or at least because the value growth of the order intake was quite high, 50%, 60%, 120%, and in that you were very confident that that value growth is largely getting passed on. It's nothing that we are undercutting on the value side in order to get the orders. But when that corroborates to your margins, it's like optically very low, and I'm assuming the commodity pressure is across the industries. But looking at your margins is something really at a very low level. So one, if you can throw some light, is it more of aggressiveness in the orders which led to this as well? How much was the commodity impact in the margin? And which you aspire to become a double-digit margin company, taking your margins from 6-7% to 12%, doing already a top line of a quarterly run rate of 1,700 crores, how would that margins go to that side? That's my first question.
Okay, and Nitin, I'll first start by by indicating and sharing that on the statement that you have made, the fact that are we cutting down prices to win projects, I will say absolutely not. What happened in this last quarter, and you can come back and say maybe we guys should have been doing better in looking around corners. We did not do as much of a good job. But what happened in March and April was unprecedented. Yes, the way the commodity prices went up, and we have a chart which shows what happened between December to March and then April. Steel was just in days was going up 20%, 30%, nickel aluminum up 100%, styrene jumped up. So almost everywhere we looked, everything had gone up massively. Yeah, and while you have when you bid those projects, you bid them with the sense of margins that you have. You are constantly executing, and the backlog that you have and the pressure that we have for deliveries continues to be extremely high. So that particular portion that we executed during that period was went through a bit of challenge, or you can say more than a bit of challenge, because the impact of commodity prices was quite substantial to the tune of 6% to our bottom line. Let's take this 6% and divide it into its individual categories a little bit. One big place, the single biggest place, was in our chemicals business. Mm-hmm. And our chemicals business, which last year was easily the most profitable part of our business, and our year before was the stellar part of our business. Q4, when we finished at zero. Yeah, and Q4 actually, when we finished our March quarter, we lost money. Mm-hmm. And April, on a run rate basis, we lost money in our chemicals business. It was also a business that we were doing a lot of actions in the background. Yeah, passing freight charges back to the customers. Many of our lower margin accounts we were getting out of. We were also redoing the analytics behind to be able to do a lot of work. We were going through cost out at the refinery, going through a new ERP. So it was just a business that went through hell. And the result of all of that is now starting. It also was a time period where our mix was really bad on specialty chemicals, both Q4 and Q1. Our mix on specialty chemicals was practically at an all-time low. Mm-hmm. Part of that is now behind us, to the point that we can comfortably say that Q2 we will post a double-digit profitability on chemicals. So I think that is one big part of the numbers that you had. Mm-hmm. The second part where we had a difference was on FGDs. The backlog that we have, there was nothing we could do. Commodity prices went up. The delivery cycle on these projects was quite long. And so there was nothing we could do. We had to take the hit, eat it, and move forward. And the FGDs continued to be a drain on the environmental segment. The good part on the FGDs is the backlog that we have now, which is what we were worried about even last time when we spoke. That backlog now is back at a cost of that backlog is back at a place which is only slightly higher than when we bid those projects and not a lot higher. Because where commodity prices are, they are behind, or they are somewhat lower than where prices were last December. Yeah, and some of these projects we had bid were in the March to June frame. So that June to December price increase, we still have to absorb and take that out through productivity. But all the December onwards cost increases, we hopefully, should be manageable given how commodity prices have come down. So that was on the environmental segment. On the energy segment, which is the heart of our business, there you can see we could absorb the commodity pressures and still turn out a decent margin. And that should hold in Q2 and Q3. I think I would not go far to say that double digits is something that you can expect immediately. But in terms of strength and margins, Q2 and Q3 should definitely be better than where we showed Q1 as. Yeah, and chemicals easily being the single biggest turnaround, please. Okay. I hope I answered your question,
Yes, sir. Thank you so much. It was helpful. Second, on the bid pipeline, can you throw some light in terms of the large orders and as well as the base orders? Any changes do you see? Because last year has been heavy from the petchem part for us. So this year, if you can throw some light on the bid pipeline, both in the base as well as in the large side orders. Thank you, sir.
Bid pipeline on the base is reasonably good. So Q2, we have a decent visibility, and it's happy with what we see. The large projects continue to be there, but on the large projects, in some cases, especially last quarter, we were little conservative on our pricing and all that with what was happening on the commodity prices. So we will see how the larger ecosystem behaves there are enough projects in the pipeline. The winning thing, let's wait and see what happens.
Thank you very much, sir. I'll come back in the queue. Thanks.
Thank you.
Thank you. The next question is from the line of Sujit Jain from ASK Investment Managers. Please go ahead.
Yeah, thank you for the opportunity. Just want to check, Ashish, what is the FGD execution left in the order book currently? And then does one assume that till then the environmental margins will remain low? Because as I recollect one of your commentaries earlier in one of the concalls, where you said the experience of the players in FGD is that the margins are low.
I think if the question is specific on FGD pricing, I'll divide the FGD projects into two parts. There were two projects that we had taken previously, which were all in the 19-20 kind of a time frame. Yeah, both of those projects are now going through their final bits of execution, with one project having 95% of its material buy complete, and the other one having Mithon, how much would the number be? I think, if I remember right, 80% plus of its buyouts are complete. Yeah, so both of them are. I think we have taken hits on both of those projects. We have taken reserves, all of that. Where they are, I think it shouldn't get any worse than what it is. Yeah, so I think overall we are comfortable with both of these projects, that the bad news has been sufficiently accounted for. So on the
order backlog that I think you were possibly asking as well, Sujit, the FGD order backlog in our current numbers is about 1,800 crores.
Yeah. So and then if I could talk about the two new projects that we have, both of them, they were both bid at reasonable margins, actually accretive to our overall project businesses. There at one point our costs had gone up quite substantial, and this particular project profitability had also come down. Where things right now stand in the last 60 days, the profitability has gone back up with the softening in commodity prices, and we are looking to make sure that as much of our buy that we can finish off in this 30-day, 60-day period that we have, we want to be able to do so. So we are going forward and accelerating the ordering of many of our major items to be able to finish it off, and we may not get the 8-9% kind of profitability at which some of these projects were bid, but the 4 to 5%, which was at one point potentially our worst case. I mean, in this particular case, potentially a worst case scenario that we want to protect by closing out all the bids. So that's how I would answer your question.
Right. So which means that the margins could look up 4 to 5% kind of levels are possible FY23-24 in the environmental segment.
Absolutely.
Sure. And styrene impact, you said,
Taking that drag, but in future quarters, I would say yes.
Sure, thank you. And styrene impact, what portion of sales in chemical segment it affects? Is the understanding correct that it is mainly the raw material for resins business, and resins would be 50% of your chemicals business?
So yes, I think resins is 40% of our chemicals business. The single biggest driver of resins is styrene, but there are a lot of other raw materials that are also part of this, not just styrene. And we will have DVB, caustic lye, DVC, caustic lye. Both of those are also driver of our of many others. Yeah, the whole list of chemicals is quite long. And in Q1, what also happened was when the whole the war started, many of these commodities, which are actually not even imports and not even dependent on crude, things like caustic lye, their pricing for a 60-day period went up by more than more than 100%, like completely. Everybody just suddenly increased the prices, and these are complete consumables in a way that you order on a 1 week lead time kind of a basis, and that costing went up quite a bit. Yeah, the other thing that happened in our chemicals business was the availability of natural gas in Dahej went down quite a bit. Pricing of natural gas right after the war went up substantially, which you guys know. LNG supply went down, all of that. So that last quarter was just April and May were just hell overall.
So safe to assume we can climb back to the margins what we posted in FY22 based on your initial commentary about chemical segment now that the mix will improve.
I can't say too far out, but definitely Q2 and Q3 we can project double-digit profitability of what we can see. Yeah.
One last question. HTM, is it an in-house solution? What kind of money has been spent? This you've mentioned in your presentation. So it is a IoT solution. So what kind of capabilities you are building in-house, and what kind of spend you are doing to build those capabilities in terms of OpEx?
So Edge is our way, and this is the realization came during the COVID times where customers would reach out to us for interest services, wanting spare parts, and the whole supply chain, because of all the COVID challenges, was a little broken, to say. Yeah, that got us thinking in the way we relate and we connect with our installed base. And of the tens of thousands of units that Thermax has supplied over the years, almost 2/3 of those we had lost touch with, which means we didn't know where they were, how the customers were using it. They were sold through distributors. So who did the distributors sell it to? When were the spare parts provided? Who was even providing spare parts? So a lot of that information we did not have. Yeah, we were getting ad hoc information from customers that we are having a problem. So Edge was our response to start connecting with these customers. Think of Edge as not just a one thing. For us, it is like our iPhone 1 in a way. Yeah, there'll be a lot of different improvements that will come. And Edge 1 effectively was followed very quickly by Edge Live, which Edge 1 was connecting our customers for them to know what is the asset, for them to say, okay, I have a problem, or I need a service request, or I need a spare part, whatever the case may be. Edge Live gives the customer the ability for a portion of our portfolio, which is the heating and the related set of products, to take that asset online, which means to be able to monitor that asset continuously and have a variety of different efficiency and uptime related models running in the background, giving them fantastic insights into their asset. So we are super excited about this capability. The numbers that we'll get for a year, our projection is is not that much for the first year, because our projection for the first year in terms of just Edge Live revenue as such is only 5 to 10 crores. Yeah, but the impact it will have on our ability to service, which means in the spare parts that we provide, field services that we provide, the new products that we can sell, and overall our ability to engage with our customer much better is extremely, extremely high. So take this as a journey. We will, for the next 3 years, we'll continue to invest in that, growing this. This has been built largely in-house. We've had development partners and all. You can see we've also made a couple of minority investments in startups. They are helping us in big portions of Edge and Edge Live. Very, very excited about what the future holds. And I think in terms of total investments, the investments in the startups, we have shared what those numbers are. But our investments internally in terms of building some of this capability, building the platform, our ability to connect with the dealers and all that is of the order of a few crores.
Sure, thank you.
Thank you. The next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Hi, good afternoon, sir. I have two questions. First, if you look at TOSL business, in the annual report, you've seen almost 75% growth in this business. But when it comes to profit, it's marginal 20% growth. So if you can help us understand, A, in terms of this portfolio from 200 crores in FY22, how do we see the growth panning out in the next 3 to 5 years? Can we see the business approaching 1,000 crore mark then? And how should we look at the profitability of this business improving? Because this seems to be more of a utility-driven portfolio. So if you can help us understand the flow through profitability, it would be helpful.
So overall, TOSL is growing continuously and will continue to grow for the next 3 to 5 years. We don't see, at least for the next 12 to 18 months, we see a very strong pipeline. We should finish that business this year at a run rate that is between 300 and 400 crores. And next year we should be able to add another 100 to 150 crores for sure. So I think a line of sight in 2 years to 500 crores clearly exists. Can this get to 800 crores in 4 years? I would think possible. In terms of profitability at a project level, it is not reducing. These are all decent IRR projects. There has been some loading of costs because as we are adding these projects online, most of these projects have an incubation cost which is early on, which is starting to hit those projects. But overall, we don't see, and we are also adding headcount and all to be able to make this a long-term business. We don't see a slowdown, and our margins at a asset level are still holding strong. Yeah, Rajendran, would you want to share anything else?
Yeah, well, I think Ashish covered it. And there is also then, a fuel cost increase that has happened during the last quarter as well as this quarter in that particular business, which is a pass-through. But then I think the fuel cost, when it increases, we don't have the same level of margin that we would have on the overall project. That would be a marginal markup to a fuel cost increase. While it's reflecting in the top line as well as in the consumption cost, the margins are not as high, and hence you would see a material cost percentage going up and then profitability margins percentages being different. Those kind of things that in this business, but I think that's the structure of the business.
Sure. And the solar utility portfolio would also be housed under TOSL, or it will be under a separate subsidiary through which the project would be executed?
So I think good question. I can spend some time talking about our solar optics business. Our solar optics business is housed in FEPL, First Energy Private Limited. And that particular business showed a loss of 4 crores in this particular quarter, and that was driven by a shift in the mix. Historically, we were doing capex projects, which means we were selling equipment and doing the EPC of small rooftop projects in solar. So that is a business that we are little bit, no more than a little bit, walking away from. And our focus is on OPEX projects. And as we speak, we are executing 3 clusters on OPEX projects, one in Tamil Nadu, one in Maharashtra, and one in Gujarat. And all 3 of these should give us a projected revenue and a projected megawatts installed that is beyond our projections for the business. Yeah, so it's doing better than what we expected. But the impact of that will only start to show up in Q3. The first asset that we have in Tamil Nadu will start to show revenue in October, late October. The second asset in Maharashtra will start to show revenue in November, and the Gujarat asset, which is a hybrid asset, will not start to show revenue until Q1 of next year. So we are building up, but meanwhile that business is, because of the operating costs of the business, is taking that cost, which is a negative 4 crore profitability number that the business is taking. But we like the backlog and the pipeline that team is developing.
Got it. And lastly, if I may, in your comments on the order inflow, you did mention that the duty on steel could have some impact on large projects in pipeline. Some delays could be expected. On the flip side, if you see the commodity prices coming off, would you believe that large order inflows which were delayed from the government sector could actually see acceleration project pipeline? So if you could just corroborate and help us on both the aspects, how do you look at the large project pipeline picking in the next 6 to 9 months?
Very good question, and I don't have a 100% answer to give you. Yeah, and you hit the nail on the head when you said that the risk that you run is that some of these bigger projects, especially in steel, where there are some really big projects being talked about, those project owners may slow down those projects. So that is a clear risk. On the other side, the fact that there is softening in the commodity prices makes it much easier for the refining and petrochemical projects to hit their budgets and for those projects to go ahead. So you see a mix of both things that are possible, possible economic slowdown, making certain people in steel and potentially cement a little conservative. Meanwhile, many others who had projects that they had envisaged that were sitting on the fence may come in and say, okay, we are seeing stability, let's move forward. I don't know how things will pan out. Yeah, but as we see overall, what I can talk about is a pipeline of inquiries. A pipeline of inquiries is strong.
Done. Thanks much, sir, and all the best. Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Yeah, hi sir. Good morning. Thanks as always for your time. So, my first question is on your, your revenue and EBITDA numbers. When I look at a 3-year CAGR basis and just comparing it to Q1 20, which was the last, pretty normal kind of a quarter, your top line growth is about 5% CAGR and EBITDA will be slightly down. So, and this is coming despite us having pretty strong order backlog, and we've obviously booked very, very strong orders as well, both base and large orders. So just trying to understand, is there some constraint on RM supplies or is there a constraint from the customer side which is keeping us from ramping up our top line significantly, or do you believe that will happen maybe over the next few quarters and therefore we see a significant growth over last year?
I think I don't see any constraints right now, any significant constraints. There are always project to project moves, but any constraints in delivery, nor are there any significant customer projects where customers are not asking for delivery. If anything, this is as smooth as I remember in my 2.5 years in my current role. So comfortable with that. Our backlog that we had built up was built up with a certain maturity, and we are sticking to that maturity. We have had, during the COVID periods, there were a lot of stuff that happened, but I think now it's all smooth and manageable. I don't think internally, as an example, while we did more than 1,600 crores, our backlog internally, when we had projected, we had only projected 1,500. Yeah, so we overall each business ended up doing more than what we were projecting. And if that holds, as the backlog matures, we should be comfortable. Yeah, we don't see any particular concerns on the execution front.
Sure.
The only place where we had little bit of execution challenge was on our PTTI business, where we had a negative 3 crore loss, despite the fact that our inquiry pipeline was decent and the order backlog was decent, where there were 2 projects which we wanted to deliver, where the customers were not ready to take deliveries. But beyond that, and that is a small part of our business overall, yeah, but most of the rest of the business, not a problem.
Fair. Okay, that's good to know. So second question, as you also said, and what we are seeing on the RM side, steel, copper, aluminum, pretty much most, RM kind of correcting by anywhere between 20-25%. So just wanted to understand, how does it work, in our case, in terms of both our, large and our base orders? Do we kind of, reduce prices, once, these RM prices fall? Do we kind of largely retain our existing order backlog values, and therefore any fall in RM prices kind of results in higher margins? You're just trying to understand how does that piece work? Yeah.
So all of our projects are fixed price projects. There should not be a scenario where we would have to, customers would come back and renegotiate pricing for steel prices going down. Yes, so we haven't had anything. There may be one or two. There have been cases where people have come to call saying, can you cut down your prices and all that. But I think in all cases, we are still higher than where we were a year ago, so to speak. Yeah. So I think those are manageable discussions. We don't see a concern. I think what you will see is an improvement in margins in Q2 and Q3 clearly. You will not see that, like if our backlog is 9,500 crores and that means we need to buy 4,700 crores worth of material, that 4,700 crores, just because the steel prices have gone down by 10%, 15%, will suddenly become lower by that 10-15%. Not happen, because we have been doing, one of the things we've been pushing very hard internally is to cut the cycle from when we get a project to when we order out extremely short. Yeah, so we are trying to make sure that if we take a project, that even if it's a higher price, you are clearing out the ordering of it, so that your margins do not dilute relative to what you committed. Q1 was horrific because the pricing went up like day by day, things were going up. Yeah, and so in that 1 to 2 month period, you could do nothing to prevent yourself. So I think that portion is completely behind us. I expect Q2 to be much milder, where you see the impact of volume showing up in a much bigger way, and a moderating of overall costs.
Right. Okay. And just the last one from my side, you did touch about, large orders potentially from steel getting delayed, because of this whole export duty which has come in. If you could also touch upon, the ordering, say, from FGD, power, other, say, refining, what's the kind of backlog, the pipeline you see there, and then how hopeful are you that gets finalized?
Okay. So FGD moderate to low. We don't expect too many orders. There are some things, but I don't think we will be super aggressive, as I've stated previously. And also there is a limited amount of uncertainty in the FGD space, where many of the companies have made representations that given the steel price increase, they may be given some relief in executing these projects. So the government, I think the finance ministry had written to the industry ministry to potentially look at that delay. And so many of the customers have used that letter from finance ministry to the industry ministry to hold off and slow down their projects. Meanwhile, the reason that letter was written, which is the commodity price increases, is no longer holding true. So that industry also does not know what will happen. So we have got multiple projects which are going through the quoting phase, but we don't know what will happen to them. So I'll keep them all in the moderate to low phase. Similarly, the large steel and the cement projects, all of them, the customers are like going through with getting quotes for the projects, doing all that. Whether they go forward with the projects or not, again, we wait to see. Petrochemical, the projects are going ahead, and many of them are driven by government PSUs, where we see projects happening, and now that the commodity prices have stabilized, their bids will open and they will get awarded. Whether we win or not, we don't know, but our pipeline of projects here is strong. Beyond this, in portions of international, in portions of waste heat, multi-fuel, there we see considerable strength. None of these will be orders that we will come and report out, but in the to 200 crore range, we see a very, very good pipeline still.
Got that. Great. Great. That's very helpful, sir. Thank you. Best of luck.
Thank you. The next question is from the line of Deepak Krishnan from Macquarie. Please go ahead.
Sure, sir. Thank you for the opportunity. I just specifically wanted to understand on the international front, especially on the European business, what has been the impact so far, and are we seeing any material slowdown there? As well as for your chemicals and chillers business in the US, given the overall macro environment, how are we seeing order pipeline over there?
So the order pipeline overall, I think, still good. We don't see a slowdown. And our international business also in Europe, if you take an example, which is where our Danstoker business is currently, is actually seeing some of its strongest order inquiry pipeline. And that is driven by many of the countries in the European Union figuring out how do you disconnect from Russia effectively. So which means looking at biomass as an option, looking at electric boilers as an option. All of that becomes of a lot of interest, which is driving a strong order inquiry book for us. Yeah, so I think we don't see a slowdown on the international side at all. In fact, if Southeast Asia and Europe, both of which were last year somewhat slower than what we would like them, today we are comfortable, and in the case of Europe, having an order inquiry pipeline which is beyond what we think our plant can deliver, because we were cutting down capacity at the plant in the last couple of years. So don't see a slowdown right now. And even in our chillers business, as I said, that's driven by waste heat recovery and some other macroeconomic drivers which are beyond just an economic slowdown. No particular slowdown, yeah, manageable.
Sure. Just probably one follow-up question on the chemical segment first. If you kind of look at the impact of mix, impact of styrene, and impact of freight, I think how would you kind of classify all three, and where do we see probably the easing out fastest, and where do we still see some scope of work to be done? And just from an overall order book position, how much of it would you say would be fixed price, and how much of it has some form of variable or a WPI linked pass-through?
Okay. So Deepak, I understood that you wanted to understand a slightly better on the Q1 performance, and are you looking to also understand the Q2?
Yeah. So Q1, especially for the chemicals and the trend ahead, and just from an overall perspective, where are we on, fixed price versus variable price contracts?
Yeah. So I think, by and large, in a chemical business as well, it's a short cycle business, so they are primarily fixed price contracts. Of course, there are a portion of slightly long-term contracts, but they are only a portion of it. And so on the impact for quarter one, yes, I think Ashish did cover about it earlier on the commodity cost being elevated still on our resin business, and that's one of the challenge that we continue to have in terms of price pass through. So that is what is impacting us, and as well as the product mix is a significant factor, because we are different product groups with the different margins in this particular business. Resin, water treatment chemicals, construction chemicals, oil field chemicals, and so we have multiple product groups with differing margins and different customer segments which have also different margins, and so those come into play, and that's one of the reasons that we have some fluctuation in the margins. There is also certain specialty chemicals that we continue to target to improve, where the margins are better, as we have shared in the past, which also has certain role to play. So suffice to say, some of this were not in the positive side in quarter one, but yeah, in quarter two we are expecting some of the product mix issues to be in favor, specialty chemicals and some better margin orders to be executed in quarter two. And also the commodity costs declining in some of the product groups should also be positive for us. And I think Ashish earlier confirmed that we are looking for better numbers from that business on the profitability front.
Sure, thanks for that. Those are all my questions.
Thank you.
Thank you. The next question is from the line of Deepak Narnolia from Birla Sun Life Insurance. Please go ahead.
Yeah. Hello, sir. Thank you for giving me the opportunity. I have one question about your profit margin. Actually, it's been, I think, more than 2 years. Every quarter, the company is reporting a volatile margin, and off and on, there are various reasons. One of the key reasons for that is the spike in commodity price. But in that context, sir, I just wanted to know how much is your fixed price contract, and how much is variable price contract, and from when you see this, profitability coming back to 9 or 10% level.
Okay, I think I hope I understood your question right. You're talking about volatile margins, and what is the price driver of these margins, and how much are fixed price and how much are variable price. I think practically all of our contracts, and I'll state a couple of exceptions.
There's some background noise. If we can request you to mute yourself, please.
Okay. An overwhelmingly high portion of our projects are all fixed price. Here there are 2 FGD projects which have some amount of price flexibility, but other than that, our entire set of projects are all fixed price, which means when commodity prices go up, we take the hit. When commodity prices go down, we get a bit of an advantage. What is not fixed price is our products businesses and our services business, which are also fixed price, but we have the ability to react there much faster. And there our ability to react is of the of the period of few weeks, which means we can increase our prices because our quote validity is a month. So that much of a freedom and flexibility you would have to be able to increase prices overall. And then on the services side, I guess we can increase our prices even more because that's our people and everything thereabouts. Okay, as I look at our backlog, as I have said, when do you think the margins will get to 9 to 10% profitability? I don't know when was the last time we were at 9 to 10% profitability. We were always a good cash generating business, and you can see our management of working capital and all continues to be solid. In terms of margins and profitability, I think the last year and a half, the way the commodity cycles have moved, and they haven't just moved been volatile, they've just been up. It's only now in the last 2 months that we are seeing a down portion. We don't care if it's up or down. We just want stability in the commodity prices so that we can price ourselves accordingly and win those projects at the margins that we think we bid them at. So if I take just to give you an example of the kinds of things that happen. Steel, long steel, 58 rupees per kg. March 22, 71 rupees per kg. BQ plates, 80 rupees per kg in December. March, 105 rupees per kg. Aluminum, 152 rupees per kg, 278 in March. Nickel, 1,500 rupees per kg in December, 2,750 in March. So we can't, it's just not something that we could absorb through into our business. The good part is by June, a lot of that has calmed down again. We are back to where we were in December. So I hope you will start to see profitability also, which is relative to how we bid it in December. And I think I challenge our teams, and I'll put it out there to look at Q2 and Q3 as a performance that at least a sense of direction on what we are working on. It won't be 10% profitability, but it'll be much better than what we showed in Q1. I personally, from my point of view, Q1 was a fantastic performance because of everything that we had to take in and to be able to still deliver a profitability which showed the power that scale can bring in. And so with a 1,600 crore top line, if we could deliver that kind of a profitability with the 9,500 crore backlog, which you can see if you break it down, what kind of top line we can deliver in future quarters, the impact on the top line with the softened commodity prices should be something that I'm looking forward to delivering.
And sir, in your backlog, how much is product and services and how much is project? If you can broadly split that.
In our backlog, we have more projects than products relative to history because we have been winning a lot of bigger stuff. But everything that we have has grown. Like in this particular quarter, we grew, our projects business from 1,230 crores of the orders we got this quarter were projects, 790 crores were products, and 300 crores were services. All three of them are 20% above relative to what it was in Q1 of last year in terms of the order booking. And we really, the services part, to grow that has been the focus that we have on services right now, because that is not the history of Thermax. Projects go up and down in some senses. We are right now focusing on improving our base business as well. And services profitability, if our overall profitability on a gross margin basis came down by 7% in Q1, the services profitability on the margin percentage basis came down by 1%. So we love the services part of that business and the resilience that it has to be able to be profitable, and in many ways those are the kinds of initiatives that allowed us to deliver what we were able to deliver in Q1.
The mix you didn't mention, sir, the project versus product mix in your order backlog, and has it changed in the last couple of years?
We mentioned it.
I don't know on the backlog what is the mix. See, the backlog mix is also a wrong one to look here because our services numbers, as an example, are very largely book and bill. Yeah, so if you look at our backlog, of course, our backlog will show predominantly projects. But that is not right because in any particular quarter, right now, this particular quarter is an example.
Okay, I got it. So in turnover, you can say the split, sir?
Okay.
So turnover split, I think Ashish did mention some time back. Yeah. So
Yeah.
I gave the order split on the.
Sorry, we don't have the turnover.
On the turnover split, we do not, but maybe we can do that and share that. Yeah. On the turnover split on a subsequent page, we can share that.
Okay, and the order book is largely projects.
No, 50-50, my friend. I just said, yeah, of the 2,300 crores we got, 1,100 crores was products and services, 1,100 crores was projects. So 50-50, and that is look, in our history, we would not ever be doing 1,000 plus crores in a quarter of products and services. We are super bullish on that part of our business.
Okay, thank you.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity. Ashish, sorry to harp again. You've dwelled enough on the margins front. But just to understand a more sustainable level of margins as the commodity headwinds go past us, will it be fair to say that roughly a third of our revenues on a sustainable basis will be the larger projects, which are 5-6% kind of margins? Services will be about 15%, which will be high teens, closer to 20%, and products will be 11-12%, will be the balance part of the revenue. And that is how we could get to a margin level of 10-11% on a sustainable basis.
I think not a bad summary from an aspiration basis. I think the services percentage is a little lower than what we are targeting, what you have shared. And maybe from a long-term profitability business basis, the product business may not yet be at the numbers that you are sharing. But from a direction perspective, you are absolutely right. The only other caveat that I would provide is that over time, we need to be able to show you guys the solutions part of our business separately as well, which is the question that Renu had asked on how is the TOESL business doing. And on top of the TOESL business, starting in Q3 and Q4, the solar part of the business will also start to overlay to create a solutions business, which today is maybe not as strong, but by next year will start to become possibly 700-800 crores worth of recurring revenue on a continuous basis for Thermax. So like 200-250 crores worth of our quarterly revenue will start to show up from these segments. Then on top of it, if I add the regular services revenue, a good 25% plus of our numbers should start to become a lot more stable and continuous with a decent margin associated with it. So that direction holds. And then if I add chemicals out of it, so our idea is to get more than 50%, well more than 50% of our business become predictable, stable, and hopefully with a bit more stability on the commodity pricing, lot more predictable overall.
Sure, that's helpful. Just the last question from my side. Energy transition is one of the key risks that you have been citing on. Could you just help us understand the initiatives you are taking, especially on the R&D side, and that's one part that I see Indian-owned engineering companies missing the R&D card. the efforts that you have been doing on the R&D innovation and the kind of products that you see, that the kind of up move that we are seeing, maybe hopefully next 2-3 years, and once that kind of settles down, the next leg of growth that we see from some of these products.
Bhavin, good question. And now that I think, as you know, Thermax, more and more, some of these questions are really starting to get to the core of what we are looking to do. Some we could talk about, some for, as you can imagine, since we cannot. As an example, this quarter you will see we announced this subsidiary specifically on bio-CNG. We are doing it because we think it is meaningful enough as a segment and can become sufficiently large, and we could convince a major developer of these kinds of projects, EverEnviro, to come in and actually take a stake in that subsidiary as well and become a partner. Yeah, so that's an example. That particular subsidiary right now has only 3 orders, but to take 3 orders already, each order would be 50 crores. So these will never be orders that will come and report out as an exception to the street. Yeah, but the opportunity that this creates is to create a whole different segment for Thermax, which starts with EPC of these projects. Then you can do O&M and services around these projects, create long-term revenue streams, which can be very, very interesting. So we need the time to build and grow them. One more thing that you would see that we have released, and it's a product which is already out, so it's called FlexiSource. It allows us to take various different kinds of biomass and waste and convert them into energy in 2 hours. And this has been particularly targeted to customers that currently run coal, because the boiler has the flexibility to run coal as well. So the boiler actually costs 50% more or maybe 100% more than a traditional coal boiler. But the flexibility that it gives the customer to be able to run multiple different kinds of fuels means that for many, many customers, the payback would be less than 2 years. And then it addresses their sustainability story as well. Yeah, so two small examples of the kinds of things that Thermax is able to do, which are relatively novel in the space. There are others who are also in this space, but I would say some of what we are doing is definitely unique. Yeah, many of the cooling applications that you will hear, yeah, low heat waste recovery, and taking that low heat waste recovery and driving heat pumps from it, chillers from it. I mean, the applications are numerous, and they're all driven by an R&D capability that is based on understanding the science behind absorption chillers that Thermax has, which I guess at least in the Indian framework nobody else would have. So these are all sets of things that you're working on that you're really excited upon. And none of them, are clean. I mean, you can come and do something lithium bromide, which is the heart of these chillers. Lithium bromide pricing went up 300% last quarter. 300%. So okay, you got to go absorb that in all of this that you provide. You think you have cool technology, your customers like you, but nobody is going to allow you to take a 300% cost increase on a price that they've agreed upon and manage it through. So we work through some of those challenges. But in terms of application sets, quite excited. And this is on top of everything that green hydrogen and all those other bits can come to bear with.
Thank you so much for answering this. Very helpful.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Shalin Seth from Sears Fund Management. Please go ahead.
Hi, Ashish. I hope I'm audible.
Hey, Shalin, you are. Shalin, before you ask your question, may I get a sense of How many more are in the queue? We will extend for a little bit, but that's only another 10, 12 more minutes. So could I get a sense on how many more are on the queue or in the queue?
Sir, we have 5 more participants.
Okay, so I think, Shalin, if you can just ask one question and not two, I'll try and be super brief in my answers as well so that we can run through the questions a little faster.
Yeah, that sounds perfect. I only have one. So, first of all, I would like to congratulate on this buoyancy in the order book. I think we have almost doubled our order book in the last 2 years. So my perspective is, what is the execution capability that we look at specifically in energy and environment going forward?
Fairly high. I think no concerns on execution. We are very focused on executing without adding significantly more people. Yeah, and which is a big emphasis for us. And also looking at this entire time to actually spend a little bit more, but spend it on automation, on productivity, on a lot of different things. And if you take a look, Thermax's cost of manpower through the years has gone up. Yeah, so, and last year when we finished, we were in 2021, it was north of 15%. With the numbers that happened last year, that number came down to 13%. We are really looking at how do we pay our people more, but try and focus a lot more on productivity so that we don't add people. So that whole emphasis that we have on productivity is resulting in a lot of initiatives internally. Some of them will be difficult because it's asking change, process change and all that. That will, I think, put some burden on our ability to deliver, but otherwise from a capacity point of view, availability of people, all of that manageable. Attrition is in double digits, but manageable.
Just a follow-up, so if you just keep the prices constant, if you should put a number on it possibly.
No follow-up. Put a number on?
Put a number on the execution capability, that's it.
Execution capability. So
quarterly execution.
Couldn't hear you.
If you could just put a number on the quarterly execution in energy and environment.
Quarterly execution. Is that like future backlog?
Yeah.
So future backlog, look, we have stayed away from sharing future projections in an exact number. But as I'm sharing, that we understand our backlog, we understand the maturity with which it was taken, and overall we don't see too many execution challenges right now. Yes, so I think that, I don't know, Rajan, should we share a future look on backlog? We haven't done so. Yeah, so we'll stay away from that, guys. You guys are now doing a better and better job of anyway forecasting Thermax's numbers, so I'll leave you all to it. Yeah. Thanks.
Okay, thank you.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Thanks for the opportunity. Good afternoon to all. The question that I have is more linked to the waste to energy segment. How much does it contribute, let's say India, overseas put together for you at a portfolio level? The opportunity size and the competition that you face in this segment? Thank you.
Over the last year and a half, significant, and north of 30% across our overall portfolio, because we have been running about 70% green. Of our 70% green, nearly 50% has been driven by waste to conversions of some sort. Yeah, variety of different applications. Different applications have had strength in different parts of our portfolio. The waste to energy part, the specific one which is around this, multi-fuel one that I talked to you about, that portion is around 40 to 50 crores of brand new business per quarter that we did in Q1. This is the flexi source that I was talking to you about, and non-recoverable solid waste. Overall waste to energy has been 30+% of our our portfolio in this last year continues to be extremely strong. The newer applications, this new FlexiSource that I talked about is 40 to 50 crores in Q1, continuing to grow. And like this, there are a couple of other applications also that we are quite excited about. The bio-CNG one was one more example that I talked about that we are very excited about.
Thank you. I'll keep it brief. Thank you for your response.
Thank you. The next question is from the line of Rahul Agarwal from L&T Mutual Fund. Please go ahead.
Thanks for the opportunity, sir. So just one question with respect to understanding the commodity impact on the incremental order inflow. And is this order book of 9,500 crore, can this be the peak, let's say in 1 year, 2 years, because of this commodity fall?
Sorry, could you repeat? What will peak in 1 to 2 years because of the commodity fall?
So the orders inflow and the order book that we have reached are at elevated commodity prices, and now with the commodities coming off, do you see that order inflow can also see the similar fall, and the commodity and the order backlog as well could see that kind of fall? So volume growth may not be impacted, but because of the pricing fall.
Oh, I think so. If I'll try and answer both parts of how I read that question. Can the slowdown in commodity prices signal a slowdown in the overall industry, and can that bring our top line down? I think you clarified that was not your main question, but I'll answer that question as well. I think quite possibly, and if the whole world goes through a recession, India too will go cold. You cannot be completely disconnected. So far, we are not seeing that. We're seeing a reasonably strong inquiry outlook, as I've said before. The second question which you asked, which is that some of what you are seeing in our top line is increased pricing that we would have, and as the commodity prices come down, will that pricing come down as well? I think that is also a very valid question. I would say our impact of commodity prices was in the low single digits. Was in single digits, not low single digits. Overall was of the single digits pricing. So to that amount, maybe the top line can moderate. I would take the margin side of the equation any day on that front. Because if the commodity prices come down by 15%, I would be more than happy to pass on a 7-8% price reduction to our customers. That is possible. We will see quarter by quarter. I think right now we are holding on to our price increases. We will see. It's a competitive space. I'm sure as our competition starts to reduce prices, we too may be in an environment where we have to reduce prices.
Great, sir. Thank you, and all the best.
Thanks.
Thank you. The next question is from the line of Amit Mahawar from Edelweiss. Please go ahead.
Thank you. Ashish, I just have one question. So as Thermax goes ahead with both domestic and globally led business growth model, a lot of large projects will basically creep in terms of overall share of business. The complexity of the book will keep on throwing new challenges. So just want to understand what kind of process and rigor do you follow in evaluating the large tickets, especially with respect to credit risk, payment cycles, etc. That's my question. Thank you.
I think that bit, I would say Thermax is a best practice. Here we are fairly conservative. Even in our history, previously also some of the biggest projects that we have taken, which are Dangote, Reliance, they've all been actually accretive to the business, the largest of the large, where we have been very, very conservative. If you take a look at our total business, which is a regular continuous business where we are putting a cost at day zero and the revenues get realized over the next 10 years on a continuous basis, our client list is AA and AAA. It's the who's who of the world, the top-notch FMCG customers, the top-notch pharma customers. So there is no dilution in that sense. And from a risk profile, I do think Thermax's processes overall need to improve in terms of how do we execute projects, turning and bringing it more digital, making it less manual, bringing in productivity, bringing vendors into the mix, bringing very modern technologies that are available. But from a risk perspective, we are absolutely solid.
Okay. Thank you and best wishes.
Thank you. The next question is from the line of Akshay Kothari from Envision Capital Services. Please go ahead.
I just had one question. Considering all our contracts are fixed price contracts, we would be hedging. I'm sure we would be hedging. So, sir, I just wanted to understand how much is the hedge is effective in the rising commodity price scenario.
We have looked at it in a lot of detail, and we've looked at it every time prices go up, and we haven't found a suitable hedge. Yeah, in our chemicals business, styrene and crude are related, but they are not. They don't follow each other to the extent that you would say I will go and hedge crude to get a hedge on styrene, and the cost of hedging styrene by itself is so expensive that it's not worth it. Similarly, on steel, the multiple grades of steel that we buy, and good chunk of our buy is even like stainless steel tubes for our boilers. And so we haven't found a suitable hedge at all. The only hedges that we do are on FX, and on FX we are practically 100% hedged. On commodities, we have no hedge at all.
Okay, that's it. Thanks a lot.
Thank you.
Thank you.
Okay, I think we covered all 5.
Yes, sir. I would now like to hand the conference over to Ms. Bhumika Nair for closing comments.
Yes, sir. Just thank you very much for answering all the questions and all the participants for being on the call. Wishing you all the very best, sir.
Thank you. Thanks, Bhumika, for hosting us. Wish you all the best.
Thank you. Ladies and gentlemen, on behalf of DAM Capital, that concludes this conference call. Thank you for joining us, and you may now disconnect.